All right, so we've already learned about liabilities. That's money you owe to people, right? And so we're going to look a little more deeply at current liabilities. Um, Current liabilities are money that you owe to people in the short term, right? So the first part of this chapter, we looked at like payroll. And when you do the payroll, you create all of these payables, right? Income tax payable and Social Security payable and Medicare payable. And all that means is that in this case, we're withholding the money from the employee's paycheck and then we have to pay it to whichever government entity it belongs to in the near term. Like I said, for some of them it's monthly, for some of them it's once a quarter, but you withhold it from your employee's paycheck, you owe it to somebody, so it's a payable, then you pay it off. Okay. So the rest of this chapter will look at other types of payables. And a current liability is when is a payable that's due within a year or less. That's what we call a current payable. Money you owe to somebody due within a year. All right. So here's kind of the important thing to note when you're doing this or to understand before you start to try to do the problem is who you are in the transaction. Am I the borrower or am I the lender or creditor, right? Sometimes you're the person borrowing the money, sometimes you're the person lending the money. Okay. So in real life, that's pretty easy to know, right? If you lend money to me, you know exactly what your role is in that. Like you don't have to like read context clues in a word problem to figure that out. But when we're doing word problems, you do. You have to read it carefully to see like who am I in this transaction. So recognize that both the borrower and the creditor or lender are going to have journal entries when money gets lent. Okay. So here's an example. The Bowden Company purchases merchandise on account from Coker $10,000, and the merchandise cost Coker Company $7,500. So the borrower, in other words, the person who's getting merchandise but doesn't have to pay yet, right? They're a borrower. They're just going to debit inventory and credit accounts payable, meaning I now have inventory and I have to pay these people $10,000 for it. The lender, well, they're selling stuff too, so they've got to do the whole sales account, but they're going to debit accounts receivable, money owed to them, and credit sales, and then do the whole cost of goods sold and inventory entry. So just recognize you have to know who you are in the transaction, and that will tell you whether you're going to have a payable or a receivable out of that transaction. Makes sense, right? Um, and then sometimes instead of it being a sales situation, it's just lending money to people on a note. So Bowden Company issues a 60-day 12% note for $10,000. In other words, they are loaning money. Oh, sorry, Bowden Company is borrowing money. See, you got to know what you are. That's a good point. So this term that's confusing is when someone issues a note, it sounds like they're lending the money, but that's not what it means. The issuer of the note is the person borrowing the money. Because in the good old days, what we would do is actually draw up a note that said, I am receiving this money from you, and this note is my promise to pay you this much back with interest by this date. So the note like explained all the terms of the borrowing, and it was the borrower sort of exchanging the note, the promise to pay, for the actual cash. Now it's often done much more informally. Unless you go to a bank or something, then they draw up a big old note with all the terms, okay? And then you sign it, still making you the issuer, even though they drew it up. So that's why it's confusing. Anyway, so Bowden issues a note, 12% note. So they're going to just do accounts payable. They owe 10,000, and notes payable because, so here they're paying off the accounts payable with a note. So their note increases and the accounts payable goes down. Remember, payables are liabilities which have a normal balance on the credit side. So, okay. So when we do those entries, we're going to be crediting notes whenever we borrow money. All right. I think we've beat that to death, but We can also look at like the formatting of it. Also remember that the formula for calculating interest is the principal times the rate times the time, or the amount borrowed times the interest rate times time, and that the interest rate is always given to us annualized as if it's for a full year. So our time is always going to be some fraction of a year, right? This is just like we learned about this when we did receivables, when we were the ones loaning the money. Now we'll be the ones borrowing it. But if we did a 60-day note that was at 12%, that doesn't mean we're paying 12% over the 60 days. It means we're paying a 12% annualized rate, but we're only borrowing it for 60 out of 360, or 2/12 or 1/6 of a year, right? So 10,000 times 12% times 60 over 360 gives us the amount of interest. And then we're going to be debiting our note payable, debiting our interest expense, and we'll be crediting the cash because we're paying them 10,200 back. It seems complicated, but in real life, it's like, hey, I'll give you $10,000 to pay off those accounts payable you have. And then in 60 days, you'll pay me $10,200 back, 10,000 of which will be a return of the money you borrowed, plus 200, which will be the interest. All interest is a fee that someone charges you for the using of their money. That's all it is, right? So if I buy a car, and maybe it's $30,000 and I don't have $30,000, over that lifetime of that note, I might pay $7,000 in interest, but it's worth it to me because I get the car I want today, but I end up paying $37,000 for it in the long run, right? When you understand interest, you can use it to your advantage. You can make smart decisions about when is it worth it to borrow and when is it not, or same with loaning money to people, right? When I sold my business, I carried the note. So like the guy paid me, I think we sold it for $150,000, and he paid me like 20,000 up front, and then I loaned him the money because I felt like he was trustworthy. So I was making, back when the best I could do at the bank was like 3%, I was making 4.5% on that $100,000, right, which is $4,500 in interest a year as he paid me off. And it turned out nicely for all of us because it worked good for him, it worked good for me. And so there's a time to use interest in your favor. All right. So a short-term notes payable, that's kind of what we just walked through here, but we'll give one more example. On September 19th, the Iceberg Company, Burr, borrowed cash from First National Bank by issuing a $4,000 90-day 8% note to the bank. So from Iceberg's perspective, they're the borrower. Their cash goes up because they borrowed $4,000, so it's a debit to cash, and their notes payable goes up $4,000, and that's a credit to the notes payable. Sometimes we get confused by these problems because they give you all this info up front and you think, oh, I've got to work all that interest in there. At the date when you borrow it, it's just your cash going up and your payable going up. There's no interest involved yet. But at the end of 90 days, we have to figure out how much interest we have to pay. So we take the principal, meaning the amount borrowed, times the rate of 8%, times the time, which was 90 out of 360, or 3 out of 12, right? 3 months. And that gives us our interest expense. And then when we pay it back, our notes payable goes down or is debited by $4,000. Our interest expense goes up by 80, so it's debited because expenses get debited to increase. And then the cash paid goes down or is credited 4,080. Or in other words, we got $4,000, we used it for 90 days, we gave the 4,000 back plus $80 in interest. That's how it works. Easy. All right, so let's look at one. In the guided assignment, chapter 10, part D. That's my best French. It's not great. I know that. So I could say to you, is my French good? And you could be like, no. All right. Is my French stinky? Oui. I was going to say muy stinky. I don't think that's what you say in French. All right. So here we go. We have a note payable entry for the Bennett Enterprises Company. They issue a big honking $400,000. That's the technical accounting term, a honking note. $400,000, 90-day, 5% note to Spectrum Industries for merchandise inventory. So it sounds like Spectrum is selling us some inventory, and rather than pay them in cash, we've agreed to pay them in 90 days and pay them 5% interest on it. That's really what that's telling us. Okay. All right. So number one, we're going to do the entry to journalize the note. So we're going to say, well, what's happening? Our inventory is going up, but we're not paying for it in cash. We're paying for it with a note. Again, on that first entry, we don't worry about interest or anything. It's just showing that whatever asset we're getting, sometimes we borrow cash. In this case, we're borrowing inventory, but we're going to pay back cash, right? So we just show the increase to the asset and the increase to the note payable. Then the payment of the note at maturity, we're going to figure out, we're going to reduce the notes payable. We're going to figure out the interest expense, and then our cash will go down because we're paying off the note. So the note payable, if it had a balance of 400,000 and we're now paying it off, we'll debit the account 400,000. The interest expense will take the principal times the rate times the time. So the principal is $400,000. Principal just means the amount borrowed, okay? Times the interest rate, which is 5%, 0.05. So if you just do principal times rate, that gives you the amount that interest to be for a year, okay? And then we can just say times 90 divided by 360. And it's $5,000. Because that's the fraction of the year, right? 90 out of 360. And then the amount of cash we're paying is 405,000. So that's really it. At the beginning, we got 400,000 in interest. I'm sorry, in inventory, and we promised to pay them $400,000 plus 5% interest in 90 days. And then 90 days later, we paid off the note. We incurred an interest expense of $5,000, and we paid them $405,000 in cash. You know, that's how banks work, right? They borrow money from people at one rate, usually really low. Think of what your savings account gets or whatever. And then they lend it to people at a higher rate. So right now, think about it. If the bank was paying you 1% for your money, but they're loaning it out to Bennett Enterprises for 5%, then they're making 4% on that money. Does that make sense? Bank of America, Chase Bank, both of those are two of the largest banks in the world. They have about $1 trillion in assets under management with a T. So what's 4% of $1 trillion? Well, it's 40 billion, right? Like, that's insane. So, and they make a much better gap than 4% because they also invest a lot of it in markets and in other things. So, or like credit cards, they charge about 18% for people who are using credit cards to borrow from them. So in the end, they get a margin of around, on average, something like 6 to 12%. Let's say an average of about 8 or 9. So on that $1 trillion, they're doing okay, slightly better than most of us are doing. All right. Now we're going to journalize Spectrum and Industries entries. So we're going to record it from their perspective, right? So now we're looking at, so this was what the borrower, Bennett Enterprises, would record. This is what the lender, Spectrum Industries, would record. So on that first date, they're going to show a debit to their notes receivable and a credit to their sales. So the notes receivable goes up by 400,000. and their sales goes up by 400,000. Now it's not shown on here, but they would also do another entry to record the cost of goods sold and their inventory decreasing by whatever the cost of that inventory was. But right now we're just worried about the notes receivable. Oops, I almost missed a zero. There it is. And then when they get paid the money, their cash will go up by 405,000, right? Because that's the amount Bennett Enterprises is paying them. The notes receivable, that means money owed to them, will go down by 400,000, meaning nobody owes them that money anymore, and their interest revenue will increase by 5,000. So that's just meant to sort of illustrate what the parties on either side of a loan transaction look like. Okay. Hopefully that's not too bad. That's pretty doable. Check our work, make sure I didn't screw it up. I didn't. Now you can all act with confidence that your teacher is not a complete idiot, right? It's always scary when you have a teacher that you like start to doubt. You're like, I don't know, this dude doesn't seem to know anything, right? You're like, we wouldn't have any of those of EAC, I know. Okay. I hope we don't. All right. So a weird thing that they sometimes do is what's called discounting notes payable. So instead of like, I give you $20,000 and then you give me $20,000 plus interest at the end of it, instead, what they do sometimes is they discount the note, meaning I'm going to give you an amount equal to the amount you want to borrow less interest. So like I'll give you $19,800 and then you'll pay me back $20,000 when it's due. So it's a little bit different, but it's the same idea. All it means is we're charging the interest up front, taking it out of the amount we're loaning you, and then you'll pay us back the full amount. Okay. But it's a little confusing if you've never seen it. So looks like we're missing. Yeah, I think I'm missing a slide there. So let's just look at one and that'll help explain it a little better. So let's look at number 2. All right. So a business issued a 60-day note for $60,000 to a bank. The note was discounted at 8%. Assume a 360-day year. So sometimes what we'll do is we'll just figure out the interest up front. So what we're going to do is we're going to list the cash, the interest expense, and the notes payable up front. So the best way to do this in my mind is I know the notes payable is $60,000, but I don't know how much interest expense or cash there'll be. So I have to calculate that. So to calculate the interest, again, principal times rate times time. So I'll say this is a $60,000 note times a rate of 8%. And then for a 60-day note, we would say times 60 divided by 360. So the amount of interest on a 60-day 8% note on $60,000 is $800. So now that I know my interest expense, it's pretty easy to calculate how much cash I'm going to get, which is 60,000 minus 800, which would be 59,200. So all a discounted note does is they take the interest out up front. They pay you 59,200, and then when it's mature or due, you pay them $60,000 back. So you just, when you're doing a problem like this, you have to look and say, is it a discounted note? It'll say the word discounted in there. And if it is, you're doing the interest up front. And if it's not a discounted note, then you don't do the interest until the payment. That's all. Okay. So when we pay it back, then we just do notes payable is going down or being debited, $60,000. And cash. I will say that this is less and less popular in the modern era. Like you don't see this very often because you know how much you need. So discounting is like now I'll have to figure out how much I need discounted. Like instead of just saying I'll loan you $60,000 and you pay me back 60,800, which seems a lot easier. So, but I just want to introduce you to it. It is out there still. All right. So that was part 2. All right. So if any has anybody here ever had to take a loan, like to buy a car yet in your life? Okay, so you just done it and it's scary because you owe money to people, you don't like it. So you know that most loans don't work the way these ones we're showing are, where it's like I give you 50,000 and you give me 50,800 back or whatever. Like that's not usually how it works. Usually what you do is you make payments each month on the loan for the life of the loan. So car loans are often either 36 months or 48 months or 60 months. Those are the most common terms for car loans, meaning you're going to pay it back over 3 years, making a 36-month note, making a payment every month. And every payment will have a portion of it be principal that you're returning to the company, and a portion of it will be interest that you're paying on the money you borrowed. And what happens, because each time there's a payment, that interest is being recalculated. So, so with every payment, the amount that is interest expense is going down slightly because the principal is going down. And so you have to like have it recalculated. Often when you buy under a loan like that, they'll give you a paper. It's usually a few papers that like explain each of your payments. Like payment number 1, it'll be this much principal, this much interest, and it'll have them all listed. That's called a loan amortization schedule. Um, in the olden days, what they did is you actually got like it was called like a loan book, and it like had a little coupon that you would like tear out and pay and send in with your payment each month. And now it's all done almost electronically. Probably your car loan is just like taken from your checking account once a month or whatever without any sort of forms. The plus side is it saves all that paper. The downside is I think the average consumer isn't always as aware of their financials as it used to be, where everybody kept paper records of everything. So trade-offs. So that's how an installment note works. So the issuance of an installment note looks the same. So if somebody borrowed you or lent you, I done borrowed you that. Someone lends you cash, your cash goes up and your notes payable goes up. Looks the same as any other note. Okay. But the payments start to look a little bit complicated. They're not that complicated once you figure it out. So on this one, they have a January 1st, they call it the carrying amount, which is the amount you borrowed minus any amount that you've paid back. Okay. Um, and then the interest expense is just the carrying amount times the interest rate times time. So principal times rate times time. So on this little chart, we can see there's 24,000. So here they're making just 5 payments, 1 payment a year. Okay. So at the beginning of the first year, they owe $24,000. They calculate the interest, which is 6% times 24,000 times 1 or times 12 over 12, because it's a payment for a whole year. So their interest will be 1,440. And then the amount they're going to pay, 5,698. You'll notice that stays fixed throughout the life of the loan. So to figure out how much they're paying off on the principal of the loan, you just take the note payment minus the amount that is interest, and that tells you how much of the note is being paid off with that first payment. And then the carrying amount at the beginning of the year minus the amount paid off tells you how much is left on the loan. That carries forward to the beginning of the next year. Figure out the interest by taking the interest rate times the amount owed. And so what's happening is with each payment, the payment is paying off more of the principal and the interest expense is less because we're paying it down over time. So if you think about having to do this as a problem, it's going to have to give you certain information, like what the loan payment's going to be. You can't know that. In real life, you can just go into Excel and you can be like, one of the templates they have in there is an amortization schedule, and it'll just be like, put in the principal, the interest rate, and the amount of payments, and it'll do it for you. But we have to learn like what's going on underneath the hood, so to speak, so that we understand it. All right, so let's look at an example of one. This is a little more complicated, right? But it actually is, most notes are done this way just because of the convenience of the borrower being able to make the same monthly payment every month, right? It's just nice to know my car payment's $300 or whatever it is. Mine is like $900, not because I have a super dope car, but because I wanted to pay it off quickly, right? I didn't want to have to pay it out over 5 years. So anyway, but it's kind of a lot right now. It's like the same amount as my house payment. All right. Oops. So let's take a look. Question number 3. So on January 1st, the Hebron Company, I have no idea, Hebron James, maybe that's to be his next kid's name. He's got Bronny Jr. and then Hebron the third, maybe. The Hebron Company issued a $175,000 8% installment note to Ventum Bank. The note requires annual payments of $43,830 beginning on December 31st. Journalize the entries to record the following: the issuance of the note, the payment of the first annual payment, and then the payment of the second annual payment. This one is nice because they're telling us even how much interest, but we could figure it out if we had to. So the issuance of the note then is just going to be our cash goes up, our notes payable goes up by $175,000. Pretty easy. And then our first payment, it tells us it has interest of $14,000 and principal of $29,830. So the payment's going to look like this. We'll have an interest expense, a note payable, and then our cash. So the interest expense, it tells us in this problem, is $14,000. And the notes payable is $29,830. And then we'll add those two together to figure out how much cash we're paying. So all this means is we're paying $14,000 in interest. That's that fee to use the money for that year. And we're paying $29,830 as a portion of the principal on the loan. We're paying down part of the money we owe. Okay. So if we add those together, what is that? 43,830. That's our payment. And again, sometimes it helps me to look at these journal entries and be like, well, what does that mean? Well, it means my cash is going down by $43,830. Well, what's it being used for? Well, $14,000 to pay interest expense and another $29,830 to pay down my notes payable. The second payment is going to have $6,253. Oh, sorry. I guess this is our third payment because it's 2015. So again, it's still going to look the same: interest expense, notes payable, and cash. $62.53, notes payable. Let's see, it tells us the remainder of the payment reduced the principal balance on the note. Oh, here's where they're kind of being mean to us. So we don't know what the principal balance is, right? So we know this. We know our first transaction. So we borrowed $175,000. And then our first transaction, so we had a carrying value on that note of 175,000. And then we multiplied it times the rate, which was how much? 8%. And that gave us our first year's interest, which was 175,000 times 8, which came out to $14,000. So our interest was 14,000, which means our principal, the amount we were actually paying down on the note, was paid down by 29,830. So this is our beginning of year, what we owe, and here's our end of year. So we would take 175,000 minus 29,830 minus 29,830. At the end of that year, we now owe 145,170. So this is year one of the note. Does that make sense? So now for year two, we start the year owing 145,170. We pay 8% interest. So times 0.08, which is, it's gonna tell, should we be rounding? Probably. So I'm going to round that to the nearest dollar. 11,614 in interest, which means our principal, if we pay 48,830 every year, is going to be 48,830 minus the amount that was interest, or 37,000. So our end of the year then will be 145,170 minus the 37,216. So at the end of the year, we owe 107,954. And we continue this each year. And then what it's telling us is this payment on December 31st, 2025 is going to pay off the remainder of the principal. You could probably imagine this would be a lot quicker and a lot easier to do with Excel than it is by hand. Because here we're having to calculate it each time. Year three, we start the year with 107,954. We pay 8% interest, which is 8636, meaning our principal is the full amount of the payment 43,830 minus 8636, or 35,000. That doesn't sound right. Hmm. 43,830 minus 8636. It looks like I made a mistake here. That's the problem. So instead, we can go to Excel, right? Because when you're doing all that math by hand, the likelihood of making a mistake is, well, significant. So here we'd say we have 175,000 at the beginning of the year. Our interest is this times 0.08. So our principal is our total payment, which is 43,830 minus the amount that is interest. And then Our new balance is principal at the beginning of the year. What? Oh, I'm doing it over here on the wrong screen. Okay, minus that. You're like, I see nothing, Fox. All right, here we go. Right, so beginning of the year, calculate the interest by doing the beginning of the year times 8%. Figure out the amount that's going toward principal by taking the total payment of 43,830 minus the amount that is interest. And then we figure out the new balance of the account by taking the beginning of the year minus the amount that's principal. In the second year, we say that equals the end of the first year. And now we can pretty quickly just, whoops, if I can click correctly. So we can have it do the math for us. Okay. So this final payment then, we have an interest expense of 62.53. Notes payable goes down by 37,577. That's that last amount. And our cash. So I'll let you guys calculate it the way you want to calculate it by hand or by Excel. The problem with Excel is sometimes you get rounding issues. If the problem wants you to round with each year, then you'll have to hand enter the years in. In fact, the way I just did it, it did that. I would have had to go back and change each one. All right. The real principle to know here is just, yes, I don't think we have time, which is why I skipped ahead. Sorry, because we only have 10 minutes left or 8 minutes left. But I'd be happy to show you on Wednesday Wednesday when it's work day. All right, so if it seemed like I skipped ahead, it was because I was like, okay, here's how you do it, but we have to work ahead. All right. Now here's another kind of interesting thing with liabilities is sometimes we have liabilities that we don't know if we're going to have to pay. They're called contingent liabilities. These are things like if somebody's suing you, you know you may have to pay, but you're not sure whether or not you have to pay or how likely it is you have to pay or how much it's going to be. So the rules are, though, that we want to make sure investors looking at our financial statements have a good understanding of our financial position. So the rules are, if we start with the contingent liability, if the likelihood of us having to pay it is probable, then we are going to report it. If it's probable and estimable, which means we can estimate the amount, we're going to actually go ahead and record that on our books as a contingent liability, meaning you'd put like, we have this payable due to this lawsuit, and it would actually go on your balance sheet. If it's probable, but it's not estimable, meaning we know we're going to have to pay something, or it's very likely we are, but we don't know exactly how much, then we just disclose the liability, which actually means when we put out our annual report, we put a note in there that says, whatever the facts are, we're being sued and this is an issue. We want you investors to know about that. So if you can estimate the amount, meaning it's estimable, you'll actually record that amount as a liability on your balance sheet. If you can't, then you just have to disclose it by a note. If it's reasonably possible, meaning we're probably like there's a good chance we'll have to, then we disclose that liability. If it's remote, then we don't have to disclose it. And this comes in real life, like you would have your lawyers saying, yes, the likelihood of this occurring, that you're actually going to have to pay out on this is either probable, reasonably possible, or remote. And then based on that, we have to disclose that information to potential investors, but with different levels from an accounting standpoint. If it's probable and estimable, we record it in our books as a liability. If it's probable and not estimable, we just disclose it as a note. If it's reasonably possible, we just disclose it as a note. And if it's remote, we're not required to report at all. Okay. So I know that's a little weird. So here we have one that's probable and estimable. During June, the company sold a product for $60,000 that includes a 36-month warranty for repairs. The average cost of repairs over the warranty period is estimated at 5% of the sales price. The entry to record the estimated product warranty expense for June is as follows. So they just tell you that you're likely to have to pay back 5,000 or 5% of that. So you take 60,000 times 5%. And since it is probable and estimable, meaning we can estimate it, we debit product warranty expense and we credit product warranty payable, meaning we expect to be paying back $3,000 on warranties during this period. Okay. If the product is repaired under warranty, and we actually have to like pay out on it, then we're going to debit the product warranty payable because we are now using up some of that payable, meaning we don't owe it anymore. And then we'll credit however we had to do. If we had to pay cash for the warranty, we'd credit cash. If we paid for supplies to fix something under the warranty, then we would credit supplies, etc. All right, let's look at question 4. Give us an idea of it. So several months ago, Ayers Industries experiences a hazardous material spill at one of its plants. As a result, the Environmental Protection Agency fined the company $240,000. The company is contesting the fine, so they're trying to not have to pay it. In addition, an employee is seeking $220,000 in damages related to the spill. Lastly, a homeowner has sued the company for $310,000. The homeowner lives 35 miles from the plant, but believes that the incident has reduced his home's resale value by $310,000. Ayers legal counsel believes that it is probable the EPA fine will stand, so that's probable. In addition, counsel indicates that an out-of-court settlement for $125,000 has recently been reached with the employee, and then the final papers will be signed next week. And counsel believes that the homeowner's case is much weaker and will be decided in favor of Ayers. All right, so journalize the contingent liabilities associated with the hazardous materials spill. So what we're saying is we believe we're going to have to pay this this one to the EPA. So we're going to do EPA fines payable. Also, we've already created a settlement with the other people, which means we're going to have to pay that, right? We've already agreed to it. So this damage award and fines is an expense. Okay. So the amount we have to pay to the EPA was how much? $240,000. And then the settlement for the litigant is $125,000. And then the expense is just those two added up, which is $365,000. So what they're really getting at here is we didn't have to record the one that was remote, where our lawyers are saying that's not going to stand. The guy's house is 35 miles away. He's not going to have a good case. But we do have to record the ones that are probable and estimable, which means they're likely to happen and we can come up with a dollar amount. All right. So the company experienced a hazardous material spill at one of its plants during a previous period. This spill has resulted in a number of lawsuits to which the company is a party. The Environmental Protection Agency has fined the company $240,000, which the company is contesting in court. Although the company does not admit fault, counsel believes that the fine payment is probable. In addition, an employee has sued the company. A $125,000 out-of-court settlement has been reached with the employee. The EPA fine and out-of-court settlement have been recognized as blank for the period, an expense for the period. There is one other outstanding lawsuit related to the incident. Counsel blank believe that the lawsuit has merit, so it does not believe it has merit. Other lawsuits and unknown liabilities may arise from this incident. All right. It is 9:50. This last part will take a few minutes. If you have to go, you may go. If you want to hang out for a couple minutes, then you can do that too, because you're a grown adult and you get to make choices. Isn't it great? All this last one is there's three different ratios that we're learning in this chapter. The working capital, which isn't really a ratio, and it's just our current assets minus our current liabilities. Current ratio, which is our current assets divided by our current liabilities. And then our quick ratio, which is quick assets, which is a new term, divided by current liabilities. And quick assets are just current assets, but not including anything that's like prepaid rent or prepaid insurance, because you can't really use that to pay your other bills. And like it doesn't include inventory because, well, you need inventory to sell. So it's just like these are the three. I'll go through them, and then that would be that. Bless you. All right, so I think we're just doing one on quick ratio here. So the Adi company reported the following current assets. They have cash, temporary investments, accounts receivable, and inventory. And then we're supposed to figure out the quick ratio, which is the quick assets divided by the current liabilities. So quick assets include, let's see, cash, temporary investments, which means money that's invested in stuff, but it's very short term, and accounts receivable, but they do not include inventory and accounts payable because that's not an asset at all, right? That's a liability. So all we're going to do is take cash plus temporary investments plus accounts receivable and then divide that by the current or the accounts payable. That's all we have to do for this. So 1140 plus 1400 plus 910 divided by 2300. It's 1.5 for 2023. And then for 2024, we have divided by 1875, 1.6. So what we have here is our quick assets on the top, our current liabilities on the bottom. So the more our assets are increasing relative to our debts or liabilities, the higher this number gets. So typically higher is considered better. So we would say that this is improving because it's getting higher over time. Okay. All right. That's all I have. If you want me to tomorrow, I can work out or show you how I used Excel and do it slower so we can all see it. Have a great day.